I make $100 or more per trade. And this is how I stay consistently profitable. So I want you to pay close attention to these numbers, the red ones and the green ones. And I want you to especially focus on the ratio of the winners and the losers. So if I have a loser, it's minus 30, minus 15, minus 13. If it's a winner, plus 100, then minus 20, minus 1, minus 40. But if I have a winner, plus 130. And you can see, if I don't have a winner, then I do get plus 40, plus 30, plus 60, minus 40, minus 26, minus 60. And then we get back to the small wins, small losses, plus 90. This is all one trade, which is about plus 70 there, plus 80. And basically, I have bigger winners and I have very small losses. And overall, in the long run, after a period of time, I can take off the profit, reset the account, and continue again doing that over and over and over again. And in this video, I want to show you the exact process that I follow so that I can catch high quality setups. And another important thing is the exit. How do I take sniper exits before losing unnecessary money? If you are new to the channel, subscribe. Let's jump into the video. First thing, your account needs at least $500 in order for you to make at least $100 on each trade. Now, you also need a very good broker. I will link my broker in the description so that you can have fast executions and very good spreads. All right, so what exactly do you need to do? So firstly, you need to understand the New York session. And not only the New York session, but all the sessions. The first hour of the session and the second hour of the session. That is when we have the most volume in the market. And this is when you want to trade so that you can have those big candles. So if you say, for example, you want to catch moves that move like this, or move like this, or move like this, you don't want to be caught in the choppiness of the market. So that is all about sessions. And these are the times that you come to the market. So for Asia, the timing window is between 9 and 11 p.m. And you change this to New York time. So I am using New York time, and you can change it to your local time to see when you need to come to the markets. For London, the time is between 3 to 5 a.m. New York time. And for New York, the time is between 9 and 11 a.m. New York time. Now, once you come to the screen at this time, you use the 5-minute time frame. And with this strategy, you don't even need higher time frames because we are scalping the moves that happen in the open. So in the open, you will see price usually picks a direction and goes maybe 50, 75, or even 100 pips. And you want to be in the move as the move is going. And then you exit quickly before it reverses and starts consolidating. Now, when you come to the screen at 9:30, what you want to identify is just an area of consolidation. And you will see, usually before 9:30, price usually sets a nice range like that. Now, once you identify your range, and you can pick the volatile indices, gold, US 30, US 100, German 40, SPY, all those, NQ, those pairs, they move explosively at the market open. And what you want to do is you want to identify when price is breaking out. So once price starts to break out, then you get in. And let's assume this blue candle or this red line, that is your entry. So as price is breaking out, you get in and then you are waiting to see if price will close as a breakout. Now, if price closes as a breakout, now you have strength in the market. Because think about it, if you are in a consolidation like that, the moment price breaks above the consolidation, it's telling you that now it's ready to move. Because all that time in that consolidation, it was trying to move past that support or resistance and it failed. Meaning the moment it breaks above it, now we have strength in the market. And breakouts are a good example of strength in the market. And so then you can wait for the next candle and you are targeting a 1:2, 1:3, 1:4, 1:5. And now this is where experience comes into play, because at first you won't know when to get out. And usually I like to get out at a 1:2, 1:3. Pushing it 1:4, that is when I have already made a good cushion throughout the week. Meaning I have now the balls to continue holding to see if price will hit my target. Now, this is what I use to determine whether to hold or to close my positions. So if price is breaking out, then at this point, I move my stop loss below this candle to secure some profits. And then when price continues to break out like that, if it does not hit my TP, I move my stops below that breakout candle. So what I'm doing essentially is securing the profits as price is moving in my direction. Now, once I see a bearish candle form, so that is a big red flag for me. And this is a sign that now the strength that I was enjoying or capitalizing on might be coming to an end. And my confirmation is when the next candle is a breakout to the downside. So I have a red candle, and if the next candle breaks out to the downside, you have to imagine that one candle as consolidation. And the moment we break below consolidation, where do you think price is headed? Obviously, price is going to head back to your stop loss. And if you have not secured anything, then you will exit at break even or even with a loss, and you are in profits. So that is why when you look at my account here, you'll notice that usually I am risking about $50. And the stop loss, I usually get out at around 30, 14, 13, 1. And not a lot of trades usually go direct to stop loss. Usually there'll be some movement, which brings us to the types of trades that you expect to see in the market using this strategy. So trade number one is full TP. And full TP, an example of full TP is a trade I took yesterday on US 100. And you can see we got in as price was breaking out. Actually, we got in somewhere here as price was breaking out. And you can see price just moves to my TP direct, no nonsense. The second one is when price goes to your stop loss immediately, like a trade on German 40. This one I did not take it, but you can see how it behaved. Price you get in, you get stopped out immediately. And there's nothing you can do about it. Then the third trade is usually a small profit or a small loss. So a small profit or a small loss is like 32, 15, 13. And a small profit is 44, 32, 60. These are trades that do not hit your TP direct. And once you understand this, then it is going to be so much easier for you to trade because you are not surprised. When you get stopped out, you understand that you could do nothing about it. But in situations where you see, all right, this pattern is telling me to exit, then you don't exit. That is your own fault. You lose unnecessary money that you could use to make more money. And that is just the game of trading. If you are an ass and you want to work with me one-on-one, there's a link in the description. Join our community and we will get in touch with you there. And for the rest of you guys, if you have any questions or you'd want to work with me, comment your thoughts on the comment section and I will definitely make videos addressing your issues. If you got value from today's video, subscribe and I will see you in the next video. Peace out.